How does off-balance sheet financing affect stock valuation? Imagine trying to judge a company's true financial health by only looking at what's visible on its balance sheet. That's where off-balance sheet financing comes into play. It's a way companies can keep certain obligations hidden from the main financial statements. Think of it like a secret stash of liabilities that aren't immediately obvious. These include things like operating leases, joint ventures, or special purpose entities. Companies use these to access funding or assets without showing the debt directly. For traders and investors, this can be a tricky puzzle. Because these obligations aren't on the balance sheet, traditional financial ratios like debt to equity or interest coverage can look better than they actually are. This makes a company seem less risky or more stable than it really is. When it comes to valuing a stock, analysts often use models like discounted cash flow calculations. These models depend heavily on the weighted average cost of capital, which combines the costs of equity and debt. If off-balance sheet obligations are treated as debt, they effectively increase the debt weight in the calculation. Since debt is usually cheaper than equity, this can lower the weighted average cost of capital, boosting the present value of future cash flows and making the stock seem more valuable. But if these hidden liabilities are ignored, the calculation underestimates the true cost of capital, leading to an overvaluation of the stock. That's why savvy traders adjust their analysis. They add the present value of future lease payments or other obligations to the balance sheet. For example, capitalizing operating leases by including the present value of future payments gives a clearer picture of a company's leverage. This helps in assessing the real risk and creditworthiness, which directly impacts stock volatility and options pricing. Market perception doesn't always catch up with these hidden risks, especially if disclosures are limited. Traders who spot and account for these off-balance sheet items can find opportunities where the market has overlooked risk. They can anticipate potential corrections or sharp moves in stock prices. Recent changes in accounting standards like ASC 140 and International Financial Reporting Standards 16 have pushed companies to record more leases on their balance sheets. While this reduces some off-balance sheet obligations, other forms still remain hidden. Staying updated on these standards helps traders keep their analysis accurate. To sum up, off-balance sheet financing can distort key financial metrics and lead to over- or undervaluation of stocks. Adjusting for these items gives a more honest view of a company's leverage and risk. This approach supports better decision-making in both stock and options trading. Always look beyond the surface numbers, especially when companies have complex structures or significant leasing activities. It's a simple step that can make a big difference in understanding true company value.